You're welcome back. The next statement we will look at is the statement of changes in equity. The statement of changes in equity shall include the following information. A. For each component of equity, the effect of retrospective application or retrospective restatement recognized in accordance with IAS 8. IAS 8 requires retrospective adjustment to effect changes in accounting policies to the extent practicable, except when the transitional provisions in another IFRS require otherwise. IAS 8 also requires restatement to correct errors to be made retrospectively to the extent practicable. Retrospective adjustments and retrospective restatement are not changes in equity, but they are adjustments to the opening balance of retained earnings. This is why this adjustment for changes in accounting policy is made at the beginning of 2016 and presented under retained earnings. You will learn more about this when we treat IAS 8 on accounting policy. And B, for each component of equity, a reconciliation between the carrying amount at the beginning and at the end of the period, separately disclosing changes resulting from profit or loss for the period, other comprehensive income, and transactions with owners in their capacity as owners, showing separately the contributions by and distributions to owners and changes in ownership interest in subsidiaries that do not result in a loss of control. Let's break this down. All these items are components of equity. The share capital, retained earnings, exchange difference from translation of foreign operation, cash flow hedges, revaluation surplus, and non-controlling interest, all are components of equity. So for the share capital, any contributions from owners of equity in form of additional contribution of capital will increase the share capital and possibly the share premium. This will arise when an entity issues additional shares to the public. And for the retained earnings, the total comprehensive income will be classified into amounts attributable to owners of parents separately from that attributable to non-controlling interest. The addition of these two will represent the profit or loss for the period. While the other part of the total comprehensive income, which is the other comprehensive income, will be classified among these items of other comprehensive income. Okay? That is why they said, for each component of equity, a reconciliation between the carrying amount at the beginning. Okay? So this is the value at the beginning. And at the end of the period, this is the value at the period. So we will separately disclose the changes resulting from the profit or loss, which is these two. Okay? And other comprehensive income, which are this. Okay? Alright. Let's look at this third one. The distributions to owners of parent in form of dividend will be deducted from the retained earnings. Okay? And the changes in revaluation surplus will be transferred from the revaluation surplus to the retained earnings. So that explains this third point, which says that the transactions with owners in their capacity as owners, showing separately contributions by, okay, which is the additional capital which increases the share capital, and distributions too, in form of dividend to owners of equity, and changes in ownership interest in subsidiaries that do not result in a loss of control. These changes in ownership interest in subsidiary is a situation where there is a disposal of subsidiaries, a more advanced scenario. We will deal with that when we get to the advanced level. However, what I want you to understand here is that this statement of changes in equity is basically explaining the reason for differences between this component of equity at the beginning, okay, and their value at the end. We want to reconcile it. Let's know the reason for differences, showing separately profit or loss, other comprehensive income, and the transaction with owners in their capacity as owners, okay, which are basically changes in equity. And the other part, which is the first point, is a scenario where there is a retrospective adjustment or retrospective restatement, which will surface at the earlier comparative period. I said we will deal with that when we get to IAS 8. So that is basically all about the statement of changes in equity. The statement of cash flows. Cash flow information provides users of financial statements with a basis to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to utilize those cash flows. IAS 7 sets out requirements for the presentation and disclosure of cash flow information. We will look at statements of cash flows in detail in a later video, okay? Not now. And we have the notes to the financial statements. The notes shall present information about the basis of preparation of the financial statement and the specific accounting policies used. Also, it will disclose information required by IFRS that is not presented elsewhere in the financial statement. You will find them in the notes. Also, it will provide information that is not presented elsewhere in the financial statement, but is relevant to an understanding of any of them. This is what we expect to see in the notes to the financial statements. The standard now says that an entity normally presents notes in the following order to assist users to understand the financial statements and to compare them with financial statements of other entities. A. We'll have statement of compliance with IFRS. B. A summary of significant accounting policies applied. C. Supporting information for items presented in the statement of financial position, statement of profit or loss and other comprehensive income, the statement of changes in equity and cash flows in the order in which each statement and each line item is presented. Okay, that is very important. That means the notes must be presented in a systematic manner. Okay, and finally is other disclosures, including the entity's financial risk management objectives and policies, the sources of estimation uncertainty, and the objective, the policies and processes for managing capital. This is the order in which the notes to the account or the notes to the financial statement must be presented. So thank you very much for your attention. See you